You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
You see how we fit the name real into the name of the show because it's like real reality radio stuff. This is real life radio. This is real life conversation about a really important topic that doesn't get the discussion that it really deserves. There are a lot of shows out there that talk about money. There's a couple of TV networks, several, that purport to talk about money, magazines and newspapers that claim to talk about money, but the place you're going to get the straight scoop, there are a couple of others, but not many, is right here. Every Saturday.
And it's a conversation, right? I mean, we're here.
Well, no, we're pretty preachy. We're pretty preachy.
Well, yeah, okay, but we'll give you a little bit of that, but if you call right now,
if you call later, you're in trouble.
Because it doesn't work. But no, we'll answer your questions. And yes, there's a few amens still to come. So I'll hold out for that.
Great. The preacher's back. 855-935-TALK. That's our phone number, 855-935-8255. And we know it's a nice day in Seattle. We know that. Look, I just looked out Tom's window. Really, it's not raining?
There isn't a raindrop within 500 miles now, my friend.
Unbelievable.
Maybe 1,000.
So call us anyway. You're stuck in traffic somewhere. 855-935-TALK. 855-935-8255. So what are we going to talk about today to get things rolling? Well, you mentioned, the nice weather, that green comes from that nice weather. Okay,
right?
if this is your attempt at a segue.
It's pretty bad,
but I'm pretty darn weak. He's trying to get from the weather to environmental issues, climate change, social responsibility, corporate governance. Yeah. In other words, ESG. If you didn't know what ESG stood for, you hear people talking about ESG investing, environmental, social governance. And
what does that all mean?
I don't know.
Okay, environmental, social, and
it means whatever somebody wants it to mean.
That's a good point. That is, because your ESG may be completely different than their ESG, right?
My ESG is like drugs, alcohol, gambling.
No, you've been out there because you've had electric cars.
I have had an electric car, and I will get another.
You're not burning up a lot of carbon. You're doing
Are you
good
kidding?
Things, right?
I never go anywhere. How can I burn carbon? I mean, I commute from like 12 feet away to my office here. It's not a...
Now, there are 2 hours or so during the week where you contribute to the heating of the environment, however, I will say.
You mean the hot air? Doing the podcast? Is that what you meant?
The podcast and the show. That adds to
that's what you meant.
The issue.
Thanks a lot. But no, there was an article today, and we love Jason Zweig. We almost always talk about his article. And again, it's another nice one. Nice job, Jason. This article, though, something caught my attention. It's not just about the social investing part of it or the environmental. It's really about the lengths financial corporations will go to squeeze more money out of you or to trick you into buying bad old funds in a new wrapper.
Yeah, 1 out of 6 of the ESG funds is an old fund that they decided to, it stinks.
We'll clean it up a little bit. It stinks in its regular, in its normal thing. Yeah.
Yeah, but try that. It's been very popular, the ESG sort of movement. 1/4 of all the new money across ETFs and mutual funds have gone in to, as you correctly point out, environmental, social, and governments. But the question to you, the audience, is, are these important investments? Because you don't call us much about them. Not much.
Well, no,
Don't do
as much. I went back through some old podcasts, just looking at what I wrote about, what the topics were. I couldn't find. Now, this is not scientific by any means, but we are listened to by tens of thousands of people every week. That we know.
That's fair. Yep.
These people tend to be very middle class to upper middle class investors. Not your ultra rich, not your very young. You guys are a little older, like us, and we don't see a clamoring for ESG on the show.
Nor, by the way, do we see it in our private management. See it much, a little bit, a few requests here and there, and some we're managing that way, but it's not huge the way this is suggesting $1 out of $4.
Yeah, and the other trick, we're going to talk about it after the break. This business about the fee structures. 855-935-TALK.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
And you are really invited to join us here at 855-935-TALK, 855-935-8255. So easy. So easy. Just call and ask you questions. Talking a little bit about these ESG funds, environmental, social, governance funds. And one of the things that the article pointed out, not as clearly as I think I would have liked, is the fact
and not till much later in the article, by the way.
Is that
seen it earlier.
This ESG moniker, designation, doesn't mean that a fund is necessarily doing much of anything different. There may be some tiny little tweaks where they overweight a little bit, but there is one big difference in a lot of them, and that's the fees.
Yeah, it's the average exchange-traded ESG ETF. Can I say that? 0.34, which he points out is greater than what an order by magnitude, right? I mean, 10 times greater.
Almost 10 times greater, because the average ETF expensive. Is like 3/100ths of 1%.
3/100ths, yeah. So this is really, he's a lot like you. He's a little cynical. He thinks this is a way for them to sort of keep making more money than they would be in their, their more vanilla index funds, which, by the way, even those, and we could talk about this later if we have a chance, dimensional funds, for example, because I've studied this quite a bit. They have a very rigorous governance program for the companies of which they are a large shareholder in. I'll put it that way. So it's not, these aren't black and white. So anyway.
But what's really curious, though, is Dimensional doesn't have their ETFs out yet, but they have a socially responsible, or an ESG, an environmental social governance fund, a sustainability fund, their core one. Sustainable, and its annual expenses, good for you, Dimensional, are lower than the average for the ETFs that do this. It's 0.2% for a Dimensional mutual fund, which should be more expensive. If they were trying to gouge people, they would do the same thing that these ETFs are doing.
Yeah, they've been ahead of the game in terms of lowering fees over the last 20 years as well.
It is.
You're correct.
Yeah, just, I don't know what to make of. You got to be careful, because you may not be getting anything.
You got to read the fine print. You really do, because one investor's paragon is another's pariah. I mean, I thought that was well put.
Ooh, yeah, I like that line. 855-935-TALK. Call us anytime. 855-935-8255. And Greg, thanks for hanging on. Welcome to the show.
Good afternoon, gentlemen. Thank you for taking my call.
Glad to do it.
I'm working on getting my arms around what has become a bit of a hodgepodge portfolio over the years, and I'm taking your advice and moving to index funds. And I would like to focus about 5% of the portfolio on an aggressive growth stock, domestic stock fund, and about 5% on an aggressive growth international fund. And I'm just wondering if you can recommend some index funds that would help me tackle.
Well, the way to go aggressive, we believe, based on history, based on academic research, is to go small cap value. Small company.
Going back, and we'll give you the numbers again because we just looked this up. Going back to 1926, U.S. small cap values made about 12.5% versus larger companies, like the S&P 500 that are more growth oriented, have made 10. So You do 2.5% more per year. It adds up very, very quickly. So Vanguard has a very fine U.S. small cap value fund. They do not have international small cap value, I don't believe.
Well, that's what I'm checking to see. I know they have.
And by the way, so if that's 10% of the portfolio, got to ask, where's the other 90% going?
Well, I'm going to shoot towards 40% overall bonds, about 20% large cap international, 5% small cap or mid cap international, 20% large cap domestic, and about 10% small and mid cap domestic.
Isn't that
so
interesting?
We would be weighting it the other way around, by the way, if we were managing that money. Go ahead, Don.
The best bet for your international small cap value is the Avantis small cap value ETF.
Good point. Do you have the ticker?
XNAS.
X as in X-ray? N
X,
as in Nancy?
Yeah, XNAS.
A as in Alpha. And S as in Sierra. Yeah. Mm-hmm.
Correct. Okay.
Yeah. And that's a relatively new fund, but the philosophy behind it has been around for a long time. These are people that left the aforementioned dimensional funds and set these exchange traded funds.
That was the wrong one. For some reason, they have the symbols. Morningstar actually has the symbol for dimensional and Avantis mixed up. That's really interesting. It is the internet. The Avantis is AVANX. But that's their. Wait a minute.
Is is in alpha. That
sounds like a fund.
We use that one. That is that with 5 on there anyway. So
okay, we're close.
You got me confused.
I'm totally confused. I mean, let me look it up. I'm going to look it up at Avantis because Morningstar seems to have weird things here. Yeah.
But good for you for cleaning up your portfolio. Good for you to move to index funds or exchange traded funds at lower costs. And good for you for really being scientific about the portfolio. By the way, if you want to spend more time on this, at our website we give 3 funds. But if you go to Paul Merriman's website, I think he has a 10-fund exchange traded fund portfolio there. If you click on paulmerriman.com. And you click on
there we go. Finally, that was their institutional fund. Their institutional small cap value ETF is AVDV.
That's U.S. or that's
international small cap value.
A as in Alpha, V as in Victor, D as in Delta, and V as in Victor.
And then they also have what looks like it should be a very good
Don't give me more tickers.
Small cap value ETF, which is AVUV.
Which I think we are using in our portfolios. Yeah.
Okay. Does that help, Greg?
Thank you, guys.
Yes, all right. Thanks so much for calling. 855-935-8255. 855-935-TALK.
Tale of the tickers.
Yeah, it's just there's so many little letter combinations, but generally the ETFs have 3 or 4 letters. They can have 2, 3 or 4.
Generally, yeah.
The funds have 5, so we have to delineate between them.
And by the way, this raises an interesting point. If you're trying to put together a do-it-yourself portfolio, we've done 3 funds, 1 U.S., 1 international, 1 bond fund, to make it simple for you, right? Now, we would expect that a more sophisticated portfolio with more exposure, if you will, to small and to value, both U.S. and international, will make you more over time. It's more work. You've got to balance that.
I mean, look at in-house. We are always looking at better ways to build the better portfolios that we build for our clients. And what we're on the brink of working on some new ETF stuff that has 10 funds?
I think it's 11.
11 funds. But again, for an individual investor,
it would be
that'll
very
make
hard
you
to manage.
crazy.
It will. Yeah, that's the thing. So that's why I'm trying to get back to what Greg was asking about. If you want to just go simple, and simple will probably be fine over the long haul.
Fine enough.
Probably.
Yeah.
Yeah. Should you make more by doing the other way? Yeah, it's more work, et cetera, et cetera.
Well, but when you have $1 million portfolio and you can increase your return by 0.5%, Now
That's a
we're
big deal.
talking real money. When you have a $10,000 portfolio, that 0.5% increase is, a few cups of coffee.
Good point.
It's all about perspective. That's why we say you can start when you're younger with the simpler, and as your portfolio gets bigger, you may want it more complicated.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Yes, it is a beautiful day in the Seattle area, and we have lines open at 855-935-TALK, 855-935-8255.
All our lines are open, so please give us a call. I'm just sitting here waiting. Hey, Seattle, come on, I know you're out there. Hey, look, I realize it's a sunny day, but on all those rainy days, I was there for you.
That's
a great line.
My wife and I have been rewatching, because there's Frasier's coming back.
I know, yeah.
They're reincarnating Frasier, and so my wife and I were watching old Frasier's on I think it was on Paramount Plus, yeah. And I saw that, and I went, "Oh, I gotta use that when it's sunny in Seattle."
We've been there for you on those rainy days.
I gotta use
all
that.
those rainy days.
And so
call. It's a good day to call, by the way, if you
Yeah.
have a question, because you'll get in more quickly.
8
And earlier, the better, too.
It's so funny too. My wife does not like the shows I like. She just doesn't. So I have to watch my shows all by myself, just like on my iPad.
Is it, we do a little violin to go here for you or something?
it's
or
kind
what?
of,
Okay.
But it turns out my daughter loves Grey's Anatomy. So she's got us watching that, which I want to slap the writers like every episode. I go, what? Who writes this?
This is a case where they didn't jump the shark. The shark actually ate the writer, and then the other guy came in and wrote.
The musical operating room number, yeah, that was a shark jumper. That was,
wow.
Woo-ha.
You told me that story.
Anyway, it seems like my television viewing now is like all Seattle all the time. That's all
those are good
there's
Seattle
shots of the Space Needle. Mount Rainier.
What's the next one? The bluest skies you've ever.
Oh, my daughter's now watching. She's watching the Engine 19, which is a spinoff from. It's a spinoff. It's a spinoff. So, but what is interesting is that the Frasers really hold up well. I was surprised, and the studio. If you ever look at the studio in Frasier, this is just a little interesting aside. For years, I was at the Walt Disney Studios at Walt Disney World.
Yes, you were.
If you look at that studio in Frasier, it looks exactly like the studio at Disney World because it was designed by the same company.
And then you left because it was a Mickey Mouse operation, so good for you.
Yeah, pretty much. Wait. I forgot who's next. John? Is that right?
John.
Yes, John. Hey, welcome to Talking Real Money.
Hey, how are you?
We're good. We're so glad you came in from the sun.
Man,
it's not good to be out in that sun.
I was able to talk to you. So glad
What's
I was
up?
able to talk to you guys today. I have a couple questions. I do some investing in some individual stocks and mutual funds.
Yeah.
But, some friends of mine, they're doing this cryptocurrency thing. One of them bought Dog E, and I was doing all this research about it.
Oh, wait.
That's our new favorite.
No, it's not called Dog E. It's called Doge, which is the name. Which is the name of the guy who started it, Shiba Inu. It's named after a
Italy,
dog.
Oh, yeah.
So
no, it's not the Doge.
Explain this to me how this cryptocurrency works, because usually with stocks or companies, they provide a service or they produce a product but where's the value? Where's the value? I don't see the value, but he likes to gamble, so he invested like $20,000 and he made like $100,000 in a week.
Yeah,
mean?
Because
But
people are stupid. John, it's because people are stupid. Well, let me just tell you the story of Dogecoin. Dogecoin is a joke. It was actually started as a joke. It is not even a serious cryptocurrency. Some guy said, well, Bitcoin's hot. I'm going to make a cryptocurrency named after my dog. And he did, and it's good nowhere. It's accepted nowhere. You can't spend your Dogecoins anywhere. The only value they have is what some other idiot is willing to pay for them. It is definitely a part of a perfect example of the greater fool theory.
And just to finish that again, what you said is absolutely correct. That is stocks are you own part of a company. Bonds, you have an IOU that's paying you a certain amount of interest. All those other things, including gold, by the way, are purely a speculation because, as Don just pointed out, it's only a matter of what the next person says it's worth. Other than that, there's nothing there that's going to make it grow.
It is the greater fool, and I just don't want to be the greatest fool. You know, the last one in the pool when all the water's been splashed out by everybody jumping in prior to me. It is a conundrum, and eventually they'll be replaced by real currencies.
Don and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
Call us at 855-935-TALK, 855-935-8255. I'm Don. That's Tom. This is Talking Real Money. And we yesterday tried something a little different. I tried something a little different. We're getting a lot of questions from you, and most of them are typed in. People like typing in questions for some reason. You know, it's like the whole phone somebody. Nobody wants to talk on the phone. They just want to text or email, and it's so much easier to talk on the phone. But hey, if it's what you like to do, it's what you like to do. And generally speaking, I read those questions and then we answer them, so we're still stuck with the same two voices, mine and Tom's. So I went to a website that actually sells what they call voiceovers, voiced by a number of different people that they've computerized, and they've computerized their voices. Well, it's not like we have to worry yet about being usurped by these guys.
Well, it's getting closer, but we're getting older anyway. So
what we're going to do, we're going to try this out for a little while to have different voices I cannot possibly know what the questioner's voice sounds like when they type their question.
Maybe they should put that on there. I have a slightly high voice. I have a southern accent.
I just do by gender. And the vast majority of our questions come from men.
Yeah, so men are such smart investors.
Well, no,
right?
they just. I think we skew male in our demo. Here's since we don't have any phone questions, we have a typed in question that was sent in to talkingrealmoney.com, and then Don, that's me, went in and did a little phonetic adjusting to try to clean up some of the stuff that was hard to understand the way the computer did it. Here you go.
Hi there. I'm a huge fan of the show and excited to have a question for you. I've been steadily moving my equities from mutual funds to their equivalent ETFs, for example, VTWAX to VT, for the slightly lower expenses and better tax treatment. I recently realized that the same is available for bond ETFs. An example is BND to replicate the Vanguard Total Bond Market Index, VBTLX for Tom's benefit. Is there any drawback to bond ETFs? Thanks for your knowledge and willingness to share it. P.S. Is that Tom in the background of a picture, refereeing a soccer game at Cal Anderson Park, in the Pacific Northwest magazine in last Sunday's Seattle Times?
Wow,
were you in the Seattle Times?
I don't know. I do read the Seattle Times, but I often don't look at the.
Did you referee in Cal Anderson Park recently?
Not in a long time.
Anyway, there's a picture. They thought it was you. So anyway, how would they know? You're on the radio.
Good-looking young man that's running up.
They were scouring the picture. Is there like a really old
guy?
Is there an old referee in it? Could be Tom.
Funny. All right. So that's very creative, by the way. So you get a gold star for that, I guess. In terms of the actual
more where
question,
that came from. Yeah.
Yeah. Good luck. In terms of the actual question, no, there's no disadvantage. It makes more sense. It's going to be cheaper than, using the exchange traded fund version. And, I would go ahead and do that.
See, there you go.
That's a short answer, but
it's an honest answer. ETFs. Let me give you a little background. There was a time when we were reticent to suggest. We were nervous about ETFs because we tend to want to err on the side of caution. We will always try to err on the side of caution. We will not go out and do crazy things like suggest you buy Bitcoin or Ethereum or Dogecoin, which is a joke, folks.
Not if it took your 20,000 and turned it into 100. It's no joke.
Because
that's no laughing matter, as we like to say. That's
real
money.
People used to go to their bookie or their numbers guy in the neighborhood and turn $20 into 100. Sometimes it happens, but it's not because you're a skilled investor. You just got lucky. But ETFs, we were really, really, really reluctant initially to tell you they're great, but as they have built a long history now, they are a great alternative to mutual funds. We still like mutual funds, index funds, not actively managed. We don't like actively managed ETFs either. But when you are getting a good index product and you can actually get it for less, which is, as we mentioned with the ESG funds, it's not always the case that the ETF version is cheaper. If the ETF version is cheaper, then sure, yeah, it's tax advantaged and it's cheaper.
The same lessons hold. I mean, you still want to use an index product. You still want to have low costs. There's tax advantages for using exchange-traded funds in taxable sort of post-tax accounts that make total sense there.
Right. 855-935-TALK. That's our phone number. Give us a call on this beautiful day in Seattle, or a really nice day if you're listening to the podcast. I'm sure we'll be back.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hi, welcome back. I'm Don. Tom's over there. This is Talking Real Money, the radio show, soon to become a podcast. Well, it's always a podcast, but this episode will become a podcast on Monday. This will be Monday's podcast. For those of you who don't know. So you can hear it again. A rerun. 855-935-TALK. It'll have fewer commercials. That I promise.
Indeed.
Yeah. Okay, we should go to the phones, right?
Mm-hmm.
Kathy, you're up next.
We were there for you.
Welcome to Talking Real Money.
Hi, Kathy.
Hi. My question is, what would you recommend for a long-term investment for our grandkids? They range in age from 4 to 12, and we kind of want to put the money there and have it grow reasonably and kind of forget about it and maybe add to it occasionally.
About how much money?
40. We're starting with 40,000.
$40,000
per kid?
No.
Oh,
per
no,
kid?
no.
Oh, spread among them.
Yeah.
I was going to send mine over there. So
yeah, you want to adopt?
And do you want this money to be spent just for them to go buy a car sometime, or do you
get
want
married or a house, or is this for school?
Education.
That's what this money is for. No, education's. We've got that.
Well. All right. Well, here's the trick, though. You probably. Oh gosh. Let me give you two choices for how it can be done. One, you can put it in your name with a payable on death, or you can transfer it later to their names. Or two, you can put it in a uniform gift to minors account, which they will take power. What?
This is not for education, or
this is not for education.
It is not.
Okay, that's maybe
not for education. So really, you got the two choices of keeping it in your own name and just mentally earmarking it for the kids with a POD, so that they don't get control when you don't want them to.
And I think she's asking what kind of investment to put it into.
Yeah, but you got to also come up with where it's going to be parked.
Yeah, no, okay, that's part one. Then part two would be how to invest that money.
And this is found money for these kids.
Yeah, but I mean, if this is money that the 12-year-old may use in 6 or 7 years, that's going to be far different than the 4-year-old who might not use it for 14 or 15.
Yeah, but again, it's not for education, so it's going to be for the 12-year-old. It could be, well, they can get it when they're at the age of majority, which you're in Washington, right?
Yes.
Which is 18 or 21?
18 here. Yeah, 18 here. You know what? I would probably then in that case just use something very simple like a target date fund of some kind.
Yeah.
Maybe the 2021, maybe like the 2040 target date fund, so you still have a lot of stock exposure. You can go to Vanguard and get it very, very inexpensive, and then you don't have to worry about managing it at all. They're taking care of the management of that fund, and you extremely inexpensive and very well diversified.
Okay, would you recommend we put that in their names or in our names with
see, that's where it really becomes that is not a question to which there's an easy answer, because here's the choices. If you put it in a uniform gift to minors account, they take control of the money at 18 years old and can do whatever they want with it, no matter what you want. You have no say, in other words.
I like the alternative, frankly.
So the alternative is to put it in your name with a payable on death or a transfer on death, so that if something happens to you, it does go directly to them without any issues. But you then decide when they get the money. So you can watch those accounts and go, okay, you're getting married, you're buying a house. Here is $40,000 for a down payment, or $10,000 or $20,000 or whatever it's grown to.
Okay, so I could do that with the target date fund, put it in our name.
Ma'am.
And
yeah.
Okay.
Yes, ma'am.
Because there's a good chance if it's payable to them on our death, I don't think they're going to be that old when we die. I mean, we're in our mid-70s. So
yeah, the other
thing, young.
The other thing you could do if you have a trust or a decent estate plan is go in through have your attorney then earmark these funds for the grandkids, but you keep control of them, keep them in your estate until you're passing. And you can even set up a successor trust that would manage those funds for a period of time after you're gone. So it's probably going to require an attorney. It's enough money, and you're going to add to it, that it would probably be wise to consult with an attorney anyway. I would assume you have an estate plan, so I would talk to that person. Thank you so much for the call. I appreciate it. 855-935-TALK is our number, 855-935-8255. And Tom, you're up. Welcome to Talking Real Money.
Thanks, guys. Hey, I got just an easy question for you. I've got $100,000 in cash that I'm going to be using for a remodel on a house we're moving into, but I'm not going to need the money for 18 months. And I'm wondering, is there anything I can do with that money for 18 months, or should I just stick it in the bank account?
Well, you can do it for 18 months. You can do it.
You could do but I would use the Vanguard short-term investment grade bond fund. That is V as in Victor, F as in Foxtrot, S as in Sierra, T as in Tango, X as in X-ray. VFSTX. It's one bond fund. It holds hundreds of securities. It's probably still what the yield. Don's looking up the yield. It's probably still, 2 or something.
No, I don't think it's that high.
I think we looked last time. It was like 2.1.
Hold on, give me the symbol.
There's some volatility. VFSTX.
Oh, VFSTX.
So there's some volatility there because it is a bond fund that the value of those securities goes up and down. I've used it for 30 years on the advice of my friend and colleague Paul Merriman, and it has been spectacular. Just to make a little more than just having it in the bank, just then sitting around making. What's the average rate? I mean, they're 0.2 or something.
Yeah,
so
a little bit of nothing. I can agree with that, but with the caveat that you need to be prepared for the possibility that in 18 months you could have less money than you put in.
That's true. Mm-hmm. Yeah. So
if
did you look up the yield?
It's right at 2. Or it's been 2 last 12 months, but its next distribution will be a little lower.
Sure.
But if you want no risk whatsoever, then about 0.6% return on an 18-month CD is about the best you can do.
Or what about high yield savings? I mean, you can go to bankrate.com and see whatever is it there. Okay, so that still makes you a little bit more, but you can go there at bankrate.com and look at those rates.
Again, though,
they cull to see what the best is.
Please, Tom, think about this carefully.
Yeah.
It is possible in 18 months you would have less money. It is
with the bond fund.
With the bond fund.
Yeah, right. I'm not arguing that. It hasn't happened to me. I'll put it that way. But it did happen in 2000.
I'm in a short-term bond fund right now.
Forget the year, but yeah, it did.
But
happen.
in the past 6 months, the value of my short-term bond fund has gone down, and not dramatically, but it's gone down enough that I'm below what I'm making, so I have a negative net return.
Yeah.
And I want you to be aware of that.
There's just a little risk associated with it. That's why you're making 2. Whereas if you go, as I say, to the high yield savings account, you're making 0.3% or whatever it is today.
But again, the reality is there could be a loss. As a matter of fact, I would put the odds of a loss in the short term slightly greater than the loss of a total gain personally. But I don't know what the future brings.
But he may not need the whole 100,000 in 18.
Maybe.
I mean, there's all kinds of other factors.
I'd be banking it. I'd be banking it probably.
All right. I'll go with the bond fund, Don, and call us in 18 months. We'll see how it turned out.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And it looks like the best rates on about 18-month CDs are in that 0.65 to 7.7% range. But then in 18 months, it'll all be there plus the $2.45 worth of interest or whatever it is.
Congratulations. Get your money back and the $2.
Yeah, we talked a little earlier about ETFs and how there are some tax advantages to them. And one of the things we want to help you do is understand the tax part of investing.
Yeah, we don't want you to overdo it, but we don't want you to underdo it. So we have a class coming up on the 29th of April at noon Pacific time, where we're going to be talking about the reasons to pay attention to taxes, how you best do it, Roth IRAs, all those kind of things that you should be paying attention to, the basics of doing it correctly. You can sign up right now at TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?